Random luck doesn't produce investment returns. Academic evidence tells us that a company's future expected cash flows do. However, within this broad statement are a whole lot of variables. For example, if you recall in video 4, and I'll put a link below, although both small company U.S. stocks and large company U.S. stocks performed great in the long term, there was a huge difference in their final amounts. This is because, as a whole, small company stocks are riskier than large, and therefore, to entice investors, their expected return must be more. As you can see in this chart, there are other factors in play too, but explaining is well beyond the scope of the short video. However, let's leave all fancy economic jargon for a second and think about two brothers, Bill and Bob. Bill is afraid to death of the volatility of the stock market and places 100% of everything he has in the safety of an FDIC-insured bank account. Bob is not as fearful of stocks and places his long-term savings in a total stock market index fund. He knows there will be plenty of periods where his account values will drop and sometimes by a lot. Let me ask you, does Bill have any right in the world to expect a long-term return like Bob? Conversely, assuming Bob doesn't simply get a thrill out of exposing his life savings to periodic gut-wrenching drops, why would he ever invest this way if he could expect the same return from plopping his money in the bank? This simple example is all about risk versus return. These two will always be inextricably linked, and if anybody ever tells you otherwise, you need to run from this advice as fast as you can. But for me, that can only be at half speed because of another risk. The risk of me pulling a hammy and being out for at least 2 months. My next topic, smart diversification.